Hi, my name is Nick Palumbo. I've been a financial advisor for 42 years. Yes, I'm an old timer. In this podcast, you're going to learn the truth and the secrets of how money really works.
Welcome to another Aligner Insider podcast.
Dean, Barry, thank you for inviting me today. I'm honored to have me. I've known Barry for how long, Barry? It's been 25 years, probably.
I'm pretty close to that.
Yeah.
I still didn't have hair, but.
Well, hello everybody out there in podcast land. This is Dean Steinman and Dr. Barry Glazer from Aligner Insider. And guess what, guys? We are back with another podcast for you. Dr. G, how are you today?
I am doing great. Day off today, Dean. How you doing?
Terrific. Doing terrific. It's middle of May now, 2024. Summer's almost here. Met season is going down the tubes really quickly, but we're Knick fans too, so we got something to smile about, right? So,
And Rangers wrapped up the series last night.
in New York, things are going good at the Garden. And speaking of going good and growing your garden, okay, we're here with a very special, handsome guest today. All right, he's back, and this is Nick Palumbo. Nick is a financial whiz, and we're here to talk about money, money, money. So, Nick, how you doing today?
Good, Dean. Thank you for having me. Barry, thank you for having me. I'm honored to be a guest on your show. I think I'd like to start off by saying that, people always say, where should I be investing my money? What should I buy crypto? Should I put it in insurance? Should I buy stocks, etc.? I want to talk about how the wealthiest people in America or the world think about money. The critical thing is how money works is more important than where you put your money. And most people don't understand how money works. So what they do is everything is transactional. They just buy products from different advisors at different points in their lives. And they do what I call junk drawer financial planning. You know how everything goes in the kitchen in the junk drawer? That's how they do their finances. They don't know why they bought it or how it makes sense. Because every decision a person makes when it comes to money causes something to go right or something to go wrong. I love to use the analogy of golf, since I have tea time today at 12:40. In golf, if I got the greatest set of golf clubs, I'm not necessarily going to be a better golfer. That's a product. But if I get lessons from Tiger Woods for 30 days and teach me the golf swing is more important than the golf club. Well, money works very much the same way. If you think of the world today, only 10% of the population controls 90% of the wealth. That's just the way it is. They're the uncommon thinkers. Warren Buffett says it the best. Whatever everyone else is doing, I'm doing the opposite. He doesn't think like the average person. And then there's everyone else, what I call the 90-10ers, okay? So we look at the economy, we look at the world, and the best way to describe what I do, if you look at your own personal finances, many of us have a CPA, an attorney, investment person, insurance person, a banker, trust officer, brother-in-law, and all of these people give you opinions at different points in time under changing economic environment. And you sit in the middle and you say, well, who do I believe? Who do I trust? Everything is opinion driven, and we become financially paralyzed. We don't know what to do. What I do is utilize this unique process. And at some point in the future, I can show it to the public to see what the process looks like, where I stress test the opinions mathematically, scientifically, so you can make intelligent financial decisions based on facts, not opinions. Let me give you an example. You've heard of the magic of compound interest. Einstein said that was great. And it is great. Here's the problem. Does anybody talk about the compounding of tax or the compounding of management fees? So a very stupid question I always ask my clients, if I could show you how to compound your wealth, but not compound your taxes, when would you want to know about it?
Yeah, exactly. Nick, I hear this all the time. Just get together with the guys or whatever, and people are bragging about their returns. And you and I have known each other for easily 20 years, and people talk about their returns. And the first thing I think to myself is, okay, did anybody think about subtracting out the 40% that you're going to pay in tax?
Exactly.
And nobody talks about that.
Nobody talks
right?
about it.
Because it's sort of like it becomes like this ego thing.
Yeah, exactly.
But but you're right. You buy stock, you buy an equity, whatever it is. You think you made, quote unquote, you made. I made all this money in the stock market. It's like, well, not really. You actually probably, half of it you're going to give to Uncle Sam,
Yeah,
right?
exactly right. Exactly right.
Yeah,
So when we talk about the accumulation of the phases of life, if you've ever gone hiking and I go up, let's say I'm going up the Himalayas, that's the accumulation phase of my life. But most deaths occur when they come down the mountain, and that's distribution phase of life, right? So nobody talks about distribution. For example, it's 2008. You guys know what happened in 2008. I'm taking distribution from my retirement plan. So if I'm taking distribution and the market declined 20, 30%, I could potentially run out of money.
right,
Okay. So where's the fail-safe in the planning methodology? Okay. And then the final phase is preservation phase. Who do I want to preserve it for? And here's why the way people make decisions. If we look at the economy, there are four sectors of the economy. There's government, there's the corporations, there's the financial institutions, and then there's us, the consumers. Government, corporations, and financial institutions are in business to transfer your money away from you. They're not for profit. We're in a
right,
$35 trillion national debt. How does the government get our money? Well, they have rules. What's the rule of the government? Federal taxes, state taxes, local tax, payroll tax, sales tax, excise tax, estate tax, right? Property tax. All of these tax dollars, they're getting rid of the deficit. Then corporations also compete for dollars. Just think in dentistry with technology, right?
right.
My first cell phone was the size of my arm. Now they have the iPhone 14, whatever number they're up to. My first TV was black and white in the Bronx, with a coat hanger was the antenna with aluminum foil, so I got reception, and the remote control with the pliers because the knob came off. Right? So technology is evolving and changing. We're buying new technology, planned obsolescence, things are becoming obsolete, right? There's shipping and handling, service agreements, style changes in clothing. I have double-breasted suits in the closet. I can't wear them, right? They're out of style. Or think of sports teams. I was watching a ball game one time. Boston Red Sox had yellow jerseys on. Well, why do they have the yellow jerseys? So the consumer buys the yellow one too. Financial institutions also have rules. They want you to give them money on a regular and ongoing basis. They want to hold on to it for as long as possible, give you back as little as possible. They talk about 401ks or a SEP or a tax deduction. Well, no, it's not. It's a tax postponement. You're going to owe the tax at some point. A tax is going to be higher or lower.
All right. Could you just maybe just drill down a little bit on that one concept? So you're talking about, let's say, like a qualified
Yeah,
plan, right?
qualified plan. Now,
Right. So just could you give like for the pea brain like me,
yeah,
like the simple example of why that, because people go, oh, it's a tax deduction,
yeah,
right?
yeah.
Why it is.
Yeah, a deduction is investment property interest or your mortgage interest on a property. That's a true tax deduction, correct? They don't ask
Right.
for the money back. This is a tax postponement. So a simple question I ask my clients: $35 trillion national debt. The marginal brackets in this country since 1913 have been just under 60%. At this rate, do you think taxes have to go up or down?
They're not, well, they're probably going to go up.
Probably
Depends
going
who
to
you
go up, but
talk to.
let's just say they stay the
They're
same.
probably not going to go down
Yeah,
because someone's going to pay the bills,
yeah.
right?
So let's say they stay the same. Are you striving in life? Are you in practice to be in a lower bracket at retirement?
Well, I know the answer, but why don't you ask Dean that question?
Well, ideally, I want to pay. I want to make as much money and pay as little taxes as possible.
Exactly, exactly. But you don't want to go to the early bird specials in Florida, right?
We need
Because
so much for your
because
soul.
when we retire, we don't need less money. We need more money because we're playing more. We're vacationing. We have hobbies. We're enjoying life, right? So we don't need less money. We need more money at retirement. If I did a simple calculation on this technology that I have, and I showed, let's say, a 35-year-old dentist that's socking money away in a 401k for 30 years, guess if taxes don't go up, guess how many years it takes that person to pay Uncle Sam back the 30 years of tax savings? It's 2.5 years.
Hmm.
You're defer. See, it's a super bond for the government. They know what it is. So if I drew a pizza pie and I drew a line from the top to the center and I say, Dean, how much of this do you want to give up in retirement? You're going to draw right over the line I draw. You don't want to give up anything. Well, if taxes don't go up, 40% of that pizza pie is Uncle Sam's. It's not your money.
That, like, is thinking, in their, 40s, 50s, 60s, and they're going to retire sooner or later, to have a tax deferred, like a Roth, or take the money out now.
Yeah.
What's better?
So there are rules. I teach 10 financial rules. 10 financial rules. I'm not going to go through the 10, but one of them is money should always be in motion for you to accumulate wealth faster. Banks know how to do this great. If you put money in a bank, banks are built on what's called a fractional reserve system. A bank can lend 10 times the amount of money that they keep on deposit. They go to the Federal Reserve. So if they have $1 million on deposit, but they lend out 10 million at 5%, they made $500,000. They made 50% on the money they have on deposit.
Right.
See, they don't take on market risk, they take on credit risk. Try to have bad credit and get a loan.
Right.
So one of the principles we teach is velocity of money. Money should be in motion. In a 401k or any retirement plan, if you're younger than 60, you can't use leverage. You could borrow, but you have to pay it back with after-tax dollars. Then it grows in the plan and you're taxed again, so you get hit twice, right? There's no leverage. It's not liquid, so you can't get velocity because the money's locked up in jail. And you don't control the money because the government says, this is how much you could put in. This is who you have to include in the plan. This is when you can touch it. This is the required minimum distribution. And this is what the taxes are going to be. So it's like the fox guarding the chicken house. Now, for the listeners out there, don't go stopping your 401k. Because unless you sat down with a financial advisor that does this methodology, remember I said there's a cause and effect that happens. You have to measure it. What is the alternative? Okay. And Barry mentioned before insurance. That's just one tool, one product. Okay. How I use it, how I use the golf club, how I use life insurance, how I use, for those of you that are under 59 and a half and have money locked up in jail, if you touch it, there's a penalty, 10% penalty for early withdrawal. But there's a way to take that money out under Revenue Code 72T without a 10% penalty and use that money to put in an investment property to pay the mortgage, which is tax deductible against the income tax that you're withdrawing. We can make your IRA tax free. It's about strategies. So it's difficult. If I went to Barry, I said, Barry, I have a toothache, and he just pulled my tooth out or just gave me an antibiotic, I'm going to think twice about going to see Barry, right? You're going to probably take an x-ray of my mouth first, see what's going on, and then decide what the treatment is going to be. Well, I do the same thing. I don't do cookie cutter recommendations unless I do a blueprint. So I'll leave you guys with this. In order to have a successful financial life, you need to have 4 things and 4 things only. Number 1, you need an economic game board. Many people go to a financial advisor and they give them a 40-page report. 38 pages of boilerplate. They charge you a fee to do it. 2 pages pertain to you. It's complete guesswork. When a home is built, there's an architectural drawing for that home. And I wish we had time I could show it to you. So I create a game board, 1-pager. It's called a PS&G model. Every asset you own falls into one of these 27 dimensions or elements or boxes on this model. On this model, there's 10 rules, 50 strategies. Barry, you might have 5 strategies. Dean, you might have 6. I don't know. Okay. So once we have the model and I teach you the rules of the game board, just like playing chess, you need rules to play chess, and which strategies apply to you, you need a simulator, a technology platform that can stress test the rules of what you're doing. So we make it based on math and science rather than Nick Palumbo's opinion. And the 4th thing you need, where I come in, is you need a financial coach. So one of the things we can do for people that are on this podcast, we can offer this service for free and they don't have to replace their advisors. They can use whoever they want, but I can offer this service for free for them if anyone is interested.
So, and I can tell you, and Nick and I I don't get a kickback. Nick have no side deals or anything like that, but I can tell you that I've worked for Nick for over 20 years, and all of this stuff is true. We talk quarterly or whenever I need to, or I have an emergency or I panic. He's always gets back to me. We meet annually. I've never gotten a bill.
Wow. Okay. So, let me answer one question, Nick. As far as how does a financial planner get compensated? You
Several ways. Number one, fee base, right? Charge now. Normally, we'll charge a fee to do that, right? To go through the model. Second way they do it, the process that we use. There's 2,000 of us in the United States. By the way, many of my clients are the people you see on CNBC telling you where to invest your money. So financial advisors are my clients. Okay, so there's 2,000 of us that use this methodology. There's 500 that are good at it. There's 100 that teach it. There's very few people do it at a high level. So one way is fee-based. Second way, as you go through the process, there's going to be products that you may need in your world. Insurance, investments, annuities, whatever the products are. 99% of the time, the client says to us, no one's going to understand this the way you understand it. Can you go to the marketplace and get the products that best fit my needs? So we get compensated from the various institutions. If it's insurance, they'll pay us. If it's investments, we charge an advisory fee based on the assets we have under management. If it's under $1 million, it's 1% management fee. If it's annuity products, the companies pay us. They're no load annuities. They're not high expense annuities. So that's the second way. The third way, we get hired by advisors. A financial advisor will hire us. A CPA will hire us. An attorney will hire us, and we'll bill them for consulting to their clients. However they bill the clients is their business. So we'll bill them. So that's a third way we get paid. So fee based, product driven, other advisors that pay us a fee to consult for their clients. So those are the different ways we get paid.
okay? Great. So listen, Barry gives you the thumbs up. It works across the board. So guys out there, if you're worried about your financial future, and you should be, reach out to Nick. What would be the best way for somebody to do so, Nick? If somebody wants to get more information, learn about for you to just do a quick analysis for them, what's the best way for somebody to?
So my email is N as in Nicholas, N Palumbo, Palumbo at truviumfinancial.com. That's Truvium financial.com. Or my cell phone number, 914-703-8312.
Great. Next. This is awesome.
Yeah, and listen, and if those who want to speak to Nick, I've never ever, at the beginning of the process, had lots of questions, lots of skepticism, right, Nick?
All the time.
Never ever felt pressured. So, if anyone is interested, you can, want to text or email Nick, just mention me. He'll take good care of you, even if you don't mention me, but it never hurts, right?
Well, just so I know at least where they came from, right?
Exactly.
Because I made that offer on the podcast.
Right, but for full disclosure, I get no referral fees. Don't want any referral fees. I'm a super raving fan, so I just want to let people know that there's nothing in this for me other than the fact that I enjoy working with Nick. He's done really well for me. He's a good person, super knowledgeable, and I just want to share that with the community.
Awesome, Nick. Thanks so much. I really appreciate it. Because you have to take a look at your future. Of course, you work so hard, and you have to make sure your money works for you. And to know how money works is important. And also, use an expert. Like you should not ever let people do their own dental work. You should not do your own marketing work. Don't do your own financial work. Work with an expert.
Exactly.
It's worth it. You get the result.
Yeah, Dean, actually, let me just make a quick comment there too. So, Smile Direct Club is now, bankrupt, but orthodontists, across the board were, outraged about the quote unquote do-it-yourself orthodontics. How can people be doing their own ortho? You need to have a specialist. We have years of training and expertise, right? But then they go ahead and they sit there on Ameritrade or whatever it is, and they try to do financial planning. I suppose if you're an orthodontist who is educated and certified as a financial planner, it's one thing. But I think we conflict ourselves sometimes because we don't like when patients dictate treatment or try to do things their own way, but yet then we try to take on roles with our money that we're not trained or qualified for. So we're experts in what we do, and we hope that patients will come to us and trust us. And Nick is an expert in what he does. So leave it to the experts, and not DIY financial planning.
Exactly. Another example is you can go to Home Depot and learn how to put a roof on. Don't do it. Hire a roofer. Okay, don't just go to just don't follow somebody on TikTok and learn how to all of a sudden be a financial planner. Okay, use an expert. You work too hard for it. So Nick, thanks so much for joining us. Really appreciate it.
Thank you so much, Dean. And Barry, I'm honored. I really appreciate it. Thank
My
you.
pleasure. Thanks so much.
My pleasure.
Make sure your money works. As Barry, I know, Moneyball is one of our favorite movies. So if we're talking about money, here we go. Money, money, money. Make it work. All right. Show me the money. All right. Thanks so much, Nick.